Have you ever stopped to look at money and asked yourself a bizarre, almost childish question? Why isn't a dollar just a dollar everywhere? Think about it. We all agree that 100 centimeters equals 1 meter, and that 1 hour equals 60 minutes. Those standards are universal. But when you travel, that universal logic completely collapses. You take one United States dollar, which feels so solid in your hand. And when you try to use it in Mexico, suddenly you get nearly 17 pesos back. Travel to Europe, and that same dollar shrinks, giving you less than a euro. Then you go to Japan, and that dollar explodes into over 150 yen. It's like a financial magic trick, where the same piece of paper constantly changes its identity and power. Why does your money's strength depend entirely on where you happen to be standing? And more importantly, how is that value decided? Shifting and wobbling every second of every day on trading floors across the globe. This isn't just about travel. This is the key to understanding global power, economics, and why the price of everything, from your morning coffee to the cost of gasoline, is tied to this hidden currency battle. Stick around, because we're going to unlock the strange, invisible rules that make one country's money a global titan, and another's just a stack of brightly colored paper. The core of this mystery isn't as complicated as a finance textbook. It boils down to belief and scarcity. For thousands of years, money wasn't something you had to believe in. It was tangible. If you held a gold coin, it had inherent value because it was a piece of gold. This belief crystallized into the gold standard, a system where a country's currency was a direct claim check for a fixed amount of actual gold held in a vault. Imagine the United States Treasury saying, every dollar bill is backed by precisely 1/20th of an ounce of gold. This system gave currencies a stable, grounded value, making international trade predictable. But it was also a straitjacket. When economies boomed and governments needed to spend, especially during massive global conflicts like World War I and World War II, they needed to print more money than they had gold to back it. It was like trying to fit an elephant into a teacup. The gold supply just couldn't keep pace with the massive growth and spending of modern industrial economies. By the 1970s, the gold standard was officially abandoned by most major powers, and the world stepped into the era of fiat currency. The term fiat comes from the Latin word meaning "let it be done," and that's exactly what it is. Fiat money, like the dollar, the euro, or the yen, has value only because a government declares it does, and because the public trusts that declaration. It's a collective agreement, a shared financial fantasy we all participate in. If that trust disappears, the money becomes worthless. This is where the simple laws of the marketplace take over, turning currency value into a perpetual tug-of-war, governed by supply and demand. Think of any currency, say the Canadian dollar, not as a piece of paper, but as a publicly traded commodity. If the world suddenly needs more Canadian dollars than are currently available, the price, or the exchange rate, will naturally rise. If the world is dumping Canadian dollars, the price will fall. So, what drives this global, frantic demand for a country's currency? Let's break down the four biggest, most relentless forces. The first, and perhaps the most devastating factor, is inflation. In the simplest terms, inflation is when your money buys less stuff. It's a measure of the supply of money versus the supply of goods and services. When a central bank, often at the request of the government, prints too much money too quickly without a corresponding increase in productivity, they are diluting the existing money supply. This is financial alchemy gone wrong. Imagine your currency is a cake, and the amount of goods in the country is the size of the plate. When you keep slicing the cake into smaller and smaller pieces by printing more money, each piece, each unit of currency, gets less valuable. This has a direct and immediate impact on the exchange rate. Who, on the international stage, wants to hold on to money that is constantly losing its purchasing power? Nobody. A country with high, uncontrolled inflation is a country whose currency is rapidly being rejected by global investors, who will immediately sell it off for something more stable. We saw this horrifyingly illustrated in Venezuela and Zimbabwe, where citizens had to carry wheelbarrows of bills just to buy a loaf of bread. The moment that internal loss of trust begins, the value of the currency crashes against foreign currencies, making imports cripplingly expensive and creating a vicious economic downward spiral. The second titanic force is interest rates, the tool used by a country's central bank, like the Federal Reserve in the United States, to either cool down or stimulate an economy. Interest rates represent the price of borrowing money. When a central bank raises its key interest rate, two things happen simultaneously. Firstly, it becomes more expensive for local businesses and consumers to borrow, which slows down spending and helps curb inflation. Secondly, and critically for the currency's value, the country's bonds and savings accounts suddenly become more attractive to foreign investors. If the United States Federal Reserve hikes its interest rate to 5%, while the European Central Bank keeps its rate at 1%, money managers around the world see an opportunity. They will sell their lower-yielding euro-denominated assets and use that money to buy United States dollars so they can invest in the higher-yielding American assets. This massive, sudden influx of international demand for the United States dollar acts like a gigantic magnet, pulling its value higher on the global exchange market. The currency, in this case, the dollar, is essentially a receipt for entry into that country's high-yield investment playground. Therefore, the higher the perceived rent or return on investment, the stronger the currency becomes. But this is a tightrope walk. Raise rates too high, and you choke off domestic growth. Lower them too much, and foreign capital flees, weakening your currency. Our third critical driver is the nation's economic and political health, a factor that fundamentally dictates investor confidence. Money is a coward. It only flows where it feels safest. When international companies and investors decide where to deploy their capital, they aren't just looking at the balance sheet. They are assessing risk. Is the government stable? Are the laws clear, consistent, and predictable? Is the banking system transparent? A country plagued by political instability, civil unrest, or rampant corruption, no matter how rich in natural resources, will struggle to attract and keep foreign investment. Why would a German automaker build a billion-dollar factory in a nation where the government might be overthrown next year, or where the rules on property ownership could change overnight? If investment flees, the demand for the local currency plummets, and so does its value. Conversely, countries that establish a reputation for a strong, independent rule of law, consistent economic policy, and a highly productive, stable workforce, like Singapore or Switzerland, see a steady, reliable demand for their currency. Foreign direct investment, the building of factories, offices, and infrastructure, requires local currency for land, wages, and materials, creating a powerful, long-term underpinning for that currency's strength. Finally, we have the ancient engine of global commerce, trade, and the balance of payments. This is a simple equation of exports versus imports. When a nation like South Korea manufactures and sells millions of high-tech semiconductors and cars to the world, everyone buying those goods must eventually pay in Korean won. This massive demand for Korean won, created by global buyers who need it to complete their purchase, pushes the won's value up. This is a trade surplus, and it's a huge currency booster. On the flip side, a country that imports far more than it exports, like the United States often does, has a trade deficit. Americans are constantly spending dollars to buy foreign goods. iPhones from China, cars from Germany, wine from Italy, and those dollars leave the country, increasing the supply of dollars available globally and putting downward pressure on its value. The ultimate example of this leverage is the petrodollar system. For decades, a pact largely between the United States and Saudi Arabia dictated that oil, the world's most vital commodity, must be priced and traded in United States dollars. Since every single country needs oil, every single country is forced to hold vast reserves of United States dollars just to conduct the energy trade. This enormous, artificial demand for the United States dollar, regardless of United States interest rates or inflation, is the single biggest reason why the dollar remains the world's most dominant and resilient reserve currency. It's the required toll for entry to the global energy highway. So, when we look at the euro, the yen, or the pound, we're not just looking at money. We're looking at a composite score, reflecting that nation's inflation, interest rate policy, political stability, and trade dominance. The constant, second-by-second fluctuation in the exchange rate is simply the global market's collective, ongoing vote of confidence in that country's future. Now, a seemingly logical solution presents itself. Why not just unify all currencies? If the Eurozone can do it, why can't the world create a global dollar and eliminate all this messy exchange rate fluctuation? It sounds wonderful, but the experience of the Eurozone offers a cautionary tale. While the euro is fantastic for travel and commerce within Europe, it comes at a steep price. The loss of independent monetary policy. Imagine the Eurozone is a cruise ship with 20 different cabins, each representing a member country, but only one thermostat, which is the European Central Bank (ECB). When a major economy like Germany is running hot, perhaps experiencing inflationary pressure, the ECB might raise the interest rate to cool it down. That same rate hike, however, could be crippling to a smaller, struggling economy like Greece or Italy, which might desperately need lower rates to stimulate their own growth and employment. They are forced to live with Germany's temperature setting. When Greece experienced its severe debt crisis, it was trapped. It couldn't devalue its currency because it didn't have one. It used the euro to make its exports cheaper and jumpstart its economy, nor could it print money to cover its debts. It was stuck in a unified currency system that prevented it from using the vital economic tools needed to fix a purely local problem. Extending this situation to a world dollar would be catastrophic. One severe economic mistake by a large, irresponsible nation could instantaneously trigger a financial domino effect, pulling the entire global economy into a single, synchronized crisis. We learned from the euro crisis that for a single currency to work, the member economies must not only share money, but also share remarkably similar economic structures, fiscal policies, and cultural outlooks on debt, which is simply not the case globally. Finally, does all this mean that every country should strive to have the strongest currency possible? Absolutely not. Economic policy, like a chef, must select the right tool for the right dish. A country that imports most of its essential goods, like oil, raw materials, or sophisticated machinery, think of a small, resource-poor nation, like Singapore, benefits greatly from a strong currency. A strong Singapore dollar makes all those vital imports cheaper, keeping the cost of living and manufacturing input costs low. Conversely, a nation that relies heavily on exports for its economic engine, like China or Japan, often benefits from a weaker currency. Why? If the Chinese yuan is relatively weak, it means that when an American company exchanges its strong United States dollars for yuan, they get more yuan for the same amount of dollars, making Chinese-made products significantly cheaper and thus more competitive in the United States market. A weaker currency is an effective tool to aggressively promote exports. This is the concept behind currency devaluation, where a country actively intervenes to lower its currency's value to gain a trade advantage. A tactic that can lead to accusations of unfair trade practices and currency wars. The ideal exchange rate for any country is therefore not the strongest, but the one that achieves the optimal balance between affordable imports and competitive exports, keeping its domestic economy stable and growing. It's a dynamic, delicate balancing act that is performed every day by governments, central bankers, and millions of traders in the world's biggest, most fluid marketplace. You are now armed with the knowledge to look past the paper and see the hidden battle of confidence, interest, and trade that dictates the true power of your money, no matter where you are. Thanks for watching, and remember to subscribe if you want more deep dives into the hidden systems that run our world.